Good morning and thank you for joining us today for the WT Financial Group Investor Webinar. My name is Jane Morgan, the Investor and Media Relations Manager. And today I am joined by WTL's founder and CEO, Keith Cullen, who will expand on the recently announced full-year statutory accounts, along with providing a company update and engaging in a Q&A session. To ask a question throughout today's presentation, please use the Q&A function at the bottom of your screen. Keith, I'll hand over to you.
Yeah, thanks, Jane, and thanks for joining us, everybody. Greatly appreciate it. Okay, well, we have recently announced our full-year statutory accounts, which has been a very pleasing result and a pleasing profit in line with what we had indicated earlier in September. So I'll take the opportunity now today to go through those. Jane, if you could just flick through the disclaimer. And before we get started on the numbers, just for those of you that don't know the company well, I'll just spend a minute or two talking about our background and how we came to firstly be known as WTL, which is a name change that we had a couple of years ago, but also how we came to emerge in this space of licensee services or dealer group services. So the company was founded in 2010. Originally under the name of Spring Financial Group, and our focus was direct to consumer. So we built a practice that was a multidisciplinary practice with financial planning, accounting and tax service, and mortgage brokerage, as well as estate planning. And we did so with all salaried advisors. So across the first 7 years of our operation, we were a B2C or direct to consumer operation. We had a strong dividend history, paying out some $7 million in dividends, and we listed on the ASX under the profits test in 2015, initially under the ticker SFL. In 2017, in the wake of the Royal Commission, we took the challenging decision to pivot away from B2C, and we saw an enormous opportunity in the dealer group space. Or licensee services, which is completely different to B2C. Rather than having salaried advisors, we have now a network of independently owned financial advice practices across the country, who we provide licensing, compliance and risk management, ongoing education and professional development, and technical support and training to. We also help them with their practice management and marketing to consumers and attracting and retaining clients, these sorts of services. So as part of this transformational restructure we have over the last few years, firstly changed the name of the company to WT Financial Group. Secondly, sold out of and exited a number of those B2C operations to rationalise them and reduce fixed overheads. And then embarked on the acquisition of our first dealer group, was Wealth Today. When we acquired that in early 2018, it had some 42 advisors in the group. We set about growing that organically to more than 100 advisors before last year in June, settling in July, we acquired Century Group. And then more recently this year, in March, we settled the acquisition of Synchron. And so we now have over 400 practices and around 600 advisors, and this has seen us emerge as one of the largest groups in the country. So following these two acquisitions this year, as I've said, we're about 400 practices and around 600 advisors. And this puts us third in terms of scale, behind two institutional operators in AMP and Insignia, formerly known as IOOF, and makes us really amongst the largest of dealer groups in the country. To put that in perspective as to the scale of that, our advisors collectively have around $16 billion of funds under advice and account for annual in-force personal insurance premiums of some $360 million. Certainly makes us one of the largest, if not the largest, personal insurance book in the country. And our advisors collectively write around $25 million per annum in new personal insurance premium. How this has translated financially for us is really over the last 3 years, our shareholders have had to see profits take a backseat to our strategy, our vision for building Australia's largest non-institutional dealer group. But this year this recently completed financial year has been a very pleasing result. We came in with gross revenue of more than $103 million, delivering a GP of a bit over $11 million, which most significantly translated to an EBITDA of nearly $4 million. Underlying net profit before tax was 2.8, statutory net profit before tax 2.35, which was after we had a one-off refinancing charge of around $400,000 that was associated with the financing, the corporate debt facility that we put in place for the Synchron acquisition, saw us pay out some other debt that we had across the group. So how that translated in terms of a net profit after tax result was $1.87 million net profit after tax on a statutory basis, or about 2.3 on a, or 2.2 rather on an underlying basis. An interesting dynamic in our business is, whilst we've had a statutory tax calculation there, we have the dual benefit of both a carry forward tax losses of nearly $9 million that will see us pay out no tax on a cash basis, but we also have about $1.5 million in franking credits within the consolidated tax group. So that will enable us, as and when we return to dividends, to continue to benefit from those carry forward tax losses, not pay tax on a cash basis, but be able to look to pay fully franked dividends in due course, ahead of us paying any tax on a cash basis. All right, so the most significant part about that result that we've just posted for FY 2022 is that the significant Synchron acquisition that we settled was only settled on the 15th of March. So we had about 3.5 months of benefit from Synchron. Out of our $103 million worth of revenue, Synchron's contribution was about $35 million out of just that 3.5 months. So it's really positioned us very well heading into FY 23. Obviously, across the course of this year, as we'll have the full year benefit of Synchron and also the full year of Sentry, which we almost got the full year out of Sentry, but it in and of itself didn't settle until I think the 20th of July. So we kind of missed 3/4 of a month there, or 2/3 of a month rather. So looking forward to FY 23, our guidance for the market is for some $170 million in gross revenue, paying to a GP of around $18 million and EBITDA of $7 million plus, net profit before tax of $5 million. Depending upon how the tax calculations play out, we're expecting a net profit after tax of around $4 million. So again, very motivated. The company is to return to dividends. We haven't declared a dividend for this year just past. The directors considered it prudent to retain cash on the balance sheet. We do have a deferred payment associated with the Synchron acquisition due in March next year of about $1 million. And until such time as we get past that point, as the directors felt it prudent to retain that cash. But we certainly retain our policy of paying dividends at least annually, as and when profits and cash flow dictate that that's prudent to do that. Looking at the top shareholders, I think a key thing to note with our company is that key management personnel from the annual report account for about 30% of the share register. When you add other senior management into that, we're pushing 33% of the share register is made up of the board and management of the company. So I can tell you personally, very motivated to get back towards dividends, and I think with that level of board and management ownership, the shareholders can be confident that there's strong alignment with their interests. It is a very strong share register. We're pleased to have the likes of Summers Limited, Ariadne, IFM and Glennon Small Companies on our register. We've had really strong support from our key shareholders as we've embarked on our restructure and our acquisitions over the last couple of years. And the key thing about some of those top shareholders is they really understand financial services. They're in the space themselves and have long track records of really understanding financial networks and financial advice in Australia. So really pleasing to see them funding our vision of building a best of breed offering for financial advisors. And our vision for pursuing this growth strategy and building such a large dealer group is that we think the opportunity for advisors and financial advice in Australia has never been better. And it continues to build. The opportunity continues to build. We are right on the doorstep now of an intergenerational wealth transfer of some $3.5 billion. The baby boomers are moving into aged care. They need advice around aged care. They need advice around estate and legacy planning. The recipients of all of that wealth transfer need strategic advice around investment, and the complexities of the advice that advisors need to give continues to increase. And this means that they need the support of a strong dealer group that has the right sort of intellectual property within it to support their endeavours. But this supply-demand equation is moving in the right direction for advisors and for dealer groups. We've had a lot of advisors exit the industry over the last few years as the institutions in the banks let go of a lot of salaried personnel who have exited the space. And as new education standards have come into the marketplace, a lot of older advisors have decided to sell their businesses and exit the space, perhaps retire a little earlier than what they might have otherwise, which means we've had a decrease in the supply of financial advice at a time when demand has never been higher and continues to increase. So what we're seeing is advisors in a position to be able to charge more for their services, to run profitable businesses dealing with less clients that they might have been dealing with a few years ago. The COVID pandemic has driven a lot of Australians to think about their need for financial security, and this is increasing demand. Recent surveys have shown that some 40% of Australians have unmet advice needs. And that there's about 3.2 million consumers open to receiving advice. So a critical part of this will be if we can tap into that opportunity through some of the measures that I'll talk to in a moment that the government is proposing through their quality of advice review, that will be a real bonus for the industry. But meeting that unmet advice need is something that is really a critical issue for government from a societal perspective, much more so than it is a business issue for the industry, in so much as there is so much demand out there and such limited supply in terms of the number of advisors that the future is very bright for the industry, regardless of those steps that the government might make to address the cost of advice. The cost of advice has been increasing over the last few years, and as I mentioned, this has become quite a social or societal issue for governments and the last two governments, because the previous government decided that it needed to do something about the escalating cost of advice for consumers. And so it initiated what's known as the Quality of Advice Review, which the new Labor government has endorsed and continues to run. So a lady by the name of Michelle Levy is conducting that review at the moment. She's put out some initial recommendations and her final report is due later this year. when the Minister will consider those recommendations, but her first round of recommendations are out for consultation at the moment. And the entire focus of that quality of advice review is to try and address that issue that I talked to as really a positive for our business and for the advisors, which is this sort of shifting supply-demand equation that has driven pricing up and seen advisors dealing with less consumers for higher fees and better margins. This is a concern because it's leaving, for governments it's a concern, it's leaving a lot of consumers who need advice unable to access it. And so the quality of advice review is looking at ways of streamlining the advice process to enable licensees like ourselves and advisors within our groups to deliver advice in a more affordable way, which in and of itself would open up additional opportunities for the group. All right, so that just about wraps me up to move into Q&A. I will talk briefly about the board. I've mentioned already the strong board and management ownership of the company, accounting for some nearly 35%. We have myself, Guy Headley as our chairman, Michael Harrison, Chris Kalesis. We each have significant experience in the financial services sector and bring a range of different talents to the table, in particular across mergers and acquisitions, and also consumer marketing within financial advice. So, Jane, I think that will wrap me up in terms of the formal part of the presentation. If we've, I see we've got quite a few questions have come in there, so maybe if we could move into the Q&A.
Yeah, absolutely. And to webinar attendees, please use the Q&A function, which can be found at the bottom of your screen to ask a question. But let me kick off. So, Keith, can you tell us what impact you think the quality of advice review will have on WTL and its peers?
Yeah, look, good question. I think there's been the key recommendations out of the quality of advice review aimed at removing duplication and some simple ones there, for example, that have really worked to increase the cost of advice. There's dual pieces of legislation associated with client consent for ongoing fee arrangements. And those of you that follow the Royal Commission will know that AMP and the banks all got caught short on what they called fee for no service, which is they were collecting fees out of people's superannuation accounts without the advisors actually doing an annual meeting or delivering ongoing services to them. And to address this, as we've seen the sledgehammer taken to the walnut, is we already had fee disclosure statement obligations, the need to give an in arrears statement to clients every year, setting out the fees that you charge them and what services you delivered against what you were supposed to deliver. And then you had a renewal notice obligation that the client needed to sign a renewal slip every 2 years for you to continue to collect those fees. Well, in the wake of the Royal Commission, we ended up with what's known as annual fee consents needing to be signed by the client and sent to superannuation funds. So we've got this duplication there that just increases costs. So one of the recommendations of the Quality Advice Review was to get rid of the need to send a fee disclosure statement. Sounds like a minor thing, but it creates a big administrative burden both inside practices and also at a licensee level that only goes to increase costs. So if we can get rid of those fee disclosure statements, the consumer's still protected out of the need to sign an annual fee consent. Another was around this design and distribution obligations that were imposed upon product manufacturers who were dealing directly with consumers when they were marketing their products rather than dealing through advisors. Is a lot of the obligations within the what's known as DDO ended up getting imposed on advisors and licensees as well. Well, that was just duplication on when you have an environment where we have best interest duty and a need to deal in a particular way with clients we're advising anyway. So some of the key recommendations or the simpler ones that get rid of that sort of duplication, which I think will help advisors sort of be able to deliver services at a lower cost. The big ticket items in the Quality of Advice Review are around making it simpler, getting rid of best interest duty out of the out of legislation, and getting rid of what's known as safe harbour provision, because the author Michelle Levy sees these as introducing a lot of cost burden in practices and with licensees, and replacing those with the obligation to provide good advice, and getting rid of a lot of the paperwork heavy aspects of providing advice. So these things in and of themselves sound relatively benign. Whether there's the political will to go through with those, I don't know. One of the key ones is to enable superannuation funds and other product providers to have, other than degree qualified staff, provide simple advice to people of a transactional nature. Now, we're very supportive of that idea because we do think that it will open up the opportunity for a lot more consumers to get transactional advice that can't afford to go to an advisor and pay for a full-blown statement of advice, and frankly don't necessarily want that. However, we think for it to be there to be equitable consumer access is that same level of staff, non-degree qualified staff, should be able to deal with transactional matters by charging a fee within a practice, and that will ensure that consumers aren't just pushed down only being able to get that type of advice in a conflicted environment from a product provider, that instead they could get it from a financial advisor. And we think this or a supervised financial advisor talk, a bit similar to a paralegal or a conveyancer, if you like, within a legal practice. And we think that opens up a great sort of career development path in the industry as well. So some of those changes, I think, will definitely come into effect. Whether there's the political will to bring all of them in remains to be seen.
Thank you, Keith. Very detailed answer. Another one's popped up. So webinar attendees noted that they have read that a lot of advisors haven't passed the Financial Advisors Standards and Ethics Authority exam by the recent deadlines and have had to exit the industry. So has this had an impact on WTL?
Look, from a financial outcome perspective, we don't see it as having an impact, but for the advisors that decided not to sit the exam or that failed it 3 times, there were around 20 of those across our cohort of advisors, and I think there were several hundred sort of Australia-wide that ended up needing to come off the register. Look, of those, I'd say that 2/3 of them let the time run out and they had made arrangements to sell their businesses elsewhere, or some of them hired a financial advisor that they put into their practice and have sort of retired, other than sort of sitting in a board role. So no real major financial impact, but certainly an impact for those that didn't want to quite go yet, but hadn't managed to pass the exam.
Thanks, Keith. So another question. So the margins seem very slim for dealer groups. Do you intend to try and address this? And would you ever look to introducing your own products?
Yeah, good question. Look, I mean, certainly we've got a very large cohort of advisors, and look, to put it in perspective, our advisors would deal with well in excess of 100,000 consumers who are annually renewing $360 million of insurance, and who have assets under advice of more than $16 billion, and with statutory superannuation inflows, that's kind of the I called it the other day, the rising tide that floats all boats. So we don't have any immediate plans in that sort of product space, but it's certainly a very interesting concept, certainly looking to improve margins through participating elsewhere in the value chain. And where our advisors think there is a shortage of a particular type of product in the marketplace, we could well look to that in the future.
Thanks, Keith. Another one. So do you have a particular point of difference with other groups?
Look, I think a key thing for us is that within our DNA is we know what it's like to build a practice and to sit in front of clients every day. And whilst we have sort of changed the scale of our B2C operations, is we've very deliberately retained that B2C business under the Spring Financial Group banner, because it's easy to forget You could advisors that are critical of their dealer groups when they come and talk to us about the idea of joining us. Almost invariably, they say one of their criticisms of their existing dealer group is that it's either forgotten what it was like to sit in front of clients every day, or it never knew it. And by this, I think they mean the key personnel, and the attitude within the business is to have sort of forgotten that what is at the centre of this business is the giving of advice to consumers on a daily basis. And I'd say so. Our point of difference is that as we put advice at the centre of everything we do with our advisors, and everything we do with them is through the lens of sitting in their room with them, talking to consumers, because we live and breathe that every day.
Another one. So now that you have scale in your business, what is the vision for the future?
Yeah, good question. I mean, look, we've really just begun, if that makes sense. We saw it as critical to develop the right amount of scale in the business to underwrite the intellectual property that advisors demand. So our vision is to deliver a best-of-breed offering for advice practices that covers all of the aspects of their business that they need and really supports them in client recruitment, client engagement and client retention, but also helps them broaden their skills so that they can advise across a much broader range of matters than what they otherwise might be able to if they weren't supported by the right dealer group. So we're really wanting to refine that product offering, bring together all of the resources and the intellectual property that we had within our business ourselves with our consumer marketing and consumer engagement tools, but also in acquiring Sentry and Synchron, whilst we've been busy sort of perfecting our certain aspects of our business around risk management and consumer or client recruitment and engagement. They've been off perfecting other things within their business, such as Sentry was very focused on practice management solutions for the practices in their group and succession planning and how to price your proposition properly. So we've brought all that intellectual property into the group. And with Synchron's been running things like their fabulous next generation advisor program that's been developing young advisors in the industry. So harnessing all of this, bringing it together to deliver a best of breed proposition for advisors so that we can help them build our business, help them build their businesses that in turn builds our business. And then we'll look to how do we broaden that offering, and perhaps it is through participation in products at a later stage. But for now, we're really in the first part of this critical journey. And so given the results we've just posted and what we're looking at for this year, we think the future's looking very strong.
Thank you, Keith. Another one that's popped up. So there's been some recent talk in the financial press of the big banks contemplating getting back into the financial advice business. So what is your view on this?
Look, I would never say never. I mean, these things are cyclical. They clearly all ran for the exit very quickly in the wake of the Royal Commission. I'm not sure what the trigger would be to do that. I think potentially if the quality of advice review recommendations all got up exactly as they're listed at the moment, is from a product provider's perspective, the ability to give simple advice across product without needing to use degree qualified staff and without triggering best interest duty and conflicts priority rule and so on, might make it more attractive for them. So we wouldn't be fazed by it. We think a lot of consumers want advice that is not as conflicted as what you'd get in that sort of bank environment. So, and we certainly don't see anything happening in the immediate future. But look, maybe they'll go, in a few years' time, they'll go on a spending spree and buy up all the existing dealer groups, which is how they got into the space years ago. So,
thanks, Keith. I might just get you to have a look through the Q&A and just make sure that we've covered everything.
Sure. Well, I think there's one here. Can you please give an update on the Altor debt facility? I'm not sure understand that question totally, but just to recap and let me know by entering a follow-up question if I miss it. When we completed the Synchron acquisitions, we took the opportunity to enter into a corporate debt facility with Untitled Capital. That enabled us to pay out existing debt that we had with a range of providers, some of which we'd entered into ourselves and some of which we picked up as liabilities associated with acquisitions that we'd done. So we refinanced all of our debt and then also accessed some capital from that initial facility to pay the cash component of the Synchron settlement. So the facility is for $6.7 million in total, and we're drawn to 4.7 of that. So there's $2 million undrawn, and we have, at this stage we're reserving that, but we can draw that to pay, for example, there's an upside payment to be made associated with the Statutory acquisition. So as we put out in our consolidated financial statements the other day, subsequent to the year end, as Statutory outperformed its minimum benchmark in terms of its performance hurdle, and so there's a back end payment to be made there that we will be paying out via cash and shares, so we can draw it for that. And then there's a deferred acquisition component associated with the Synchron acquisition that's due in March next year. So at this stage, $2 million undrawn and 4.7 drawn.
Thanks for that, Keith. I think we might have covered everything there, unless you can see anything else that's popped up.
Question here about dividends. Are you saying that post-March 23 earnout, we can look forward to a dividend for June 23 second half result, which will be released in August 23? Well, certainly, look, we'll just reiterate what our objective is as a business, and the board's stated position is to pay dividends as and when cash flow and profits permit, and trust me, as our largest non-institutional and second largest overall shareholder, I'm very motivated for us to get back to dividends.
Wonderful. Thank you, Keith. I think we have covered everything now, and that's all we do have time for today. So thank you all for joining the WT Financial Group Investor Webinar. Should we have missed any questions, though, please feel free to reach out via the contact details on the bottom of our ASX releases. We look forward to hosting you again soon. Thank you.
Thanks, everyone. Thanks, Jane.